Thanks so much for joining us here today for Alliant Group's update for our CPA partners on the Biden administration in the first 100 days. I'm so pleased to have you all joining us today, and particularly pleased to have my co-panelists joining us. I think many of you know Steve Miller already, former acting commissioner of the IRS with years of time there at the IRS. And of course, the great Congressman Lazio, just a wealth of knowledge and insights on Congress and what's going on there. But I'm particularly thrilled that joining us for the first time is our newest person at Alliant Group, Eric Hilton. Eric is just brings no end of background and knowledge and experience with the IRS. He was 30 years there, a lot of time in criminal investigation, but most recently, he was the commissioner for SBSE, Small Business Self-Employed, but had a lot of responsibilities with SBSE and beyond that. And we're just so thrilled to be able to have Eric as part of our team, and great to have him. Steve, I know you dealt with Eric a good deal and can speak to him even more than I can about the wealth of experience he brings to us at Alliant Group.
I did work with Eric during my time at the IRS, and it was a rewarding experience, at least for me. I don't know how he felt about it, but at least for me, I enjoyed it. Eric was at the time, the first head of the international division of the criminal investigation division, and did a remarkable amount of work with us. That was right at the time of trying to break Swiss bankruptcy, and he has a tremendous amount of experience in that area, tremendous amount of experience in other areas we'll be talking about today, cryptocurrency, for example. And I couldn't be happier. He went on to be the deputy in criminal investigation, and then was asked by the current commissioner to step up and be the commissioner of small business. So, he went from CI, very specified, to a place where he had 20 to 25,000 employees, which is a joy that not many of us know, but a remarkable background and experience. And like you, Dean, I'm just really happy about this.
And we're so pleased too. And just for folks listening, he has just left the IRS. So kind of the insights and information he's going to give to us later on, Eric does, it's kind of fresh out of the oven. He just come there and knows at cold what's going on and what they're thinking. And Eric, we're going to get into kind of what's Washington doing. But before we do that, just any words you want to say. We've talked all about you. Might as well let you say something as well too to everybody.
No, it's truly, I appreciate that, Dan. It's a pleasure to be here with such an esteemed panel here, former Congressman Lazio. I mean, it's great, working with you and working with Dean and Steve again as well, and being a part of the Alliant family. I'm just truly honored and privileged to be a part of that. Such a great organization. And truly, as I think about it, this role that I am as a national director of compliance, I look at it as just more of an extension of my role as SBSC commissioner in helping small businesses and ensuring that they're properly taking the tax incentives that are available to them. But also, as expressed, 26 years in IRS criminal investigation. Many individuals don't even know that IRS has a federal law enforcement component, but it was spent a lot of time there working on international tax evasion issues. Public corruption was a significant area of focus. Terrorist financing, money laundering, all types of financial fraud. So enjoyed it. I had a great career, 30 years, and look forward to working with all of you at Alliant Group and with the CPAs that's on the line as well.
Thanks so much, Eric.
I want to mention, I don't know of another national organization focusing on tax that has the depth of IRS and Treasury experience that Alliant Group has. With Eric and Steve, and then on top of that, Mark Everson, former IRS commissioner, Kathy Petronchek, former chief of staff, and also a commissioner at the IRS, yourself as tax counsel for the Senate Finance Committee. It's a really unrivaled group of tax professionals with incredible experience and depth.
Well, that's very kind words. Well, let's get the folks here listening. I know they're interested in the world ahead. Rick, maybe if you can start us off, and then we'll dive into the details about what's going on in the tax proposals and what's happening. But give us the big picture, Rick, of how you see the first 100 days and kind of set the table, if you will, for our listeners.
Sure. Thanks, Dean. And welcome to all the folks listening in, particularly our CPA partners and associates. Of course, elections have consequences. One of the most hard-fought elections in recent memory, both at the legislative level, the congressional level, where I served, and for the White House. And it all came down in the end to two runoff elections in Georgia that Democrats took. Let's say slightly unexpectedly. I think that Republicans had a degree of confidence going into that election, although they were cautious. And Democrats had a very good day on that day, and as a result, they ended up with effective control of the Senate. There are now 48 Democrats and 2 independents that caucus or vote with Democrats, giving them 50. There are 50 Republicans, so it's a tie, numeric tie, and because of the Vice President Harris has the ability to break the tie, that gives Democrats effective control over the Senate. On the House side, also slightly unexpectedly, Republicans had a better election than almost anybody really predicted. They ended up closing the margin, picking up seats, and we're going to talk about that in a little bit. We ended up with 219 Democrats, 211 Republicans out of 435, and there are still 5 seats that, because of resignations, including Secretary Fudd who's over at HUD right now, that have yet to be held. And so, very close margin. We're going to talk about this a little bit later as we think about the road ahead, looking into the crystal ball and how things might play out. I'll just mention right now that most people, as we look at the races coming up in the 22 cycle, when the entire House of Representatives and 1/3 of the Senate will be up, because of reapportionment, Republicans are in a strong position, although not far from guaranteed, to take the majority in 2022. Anything can certainly happen. In the Senate, I would say there was more optimism a couple of months ago about the Republicans taking the Senate, if you were a Republican, than there is right now, with some key decisions made, including by Senator Rob Portman, who had last time run and won by about 17 points in Ohio. Key legislator sitting on the Tax Writing Senate Finance Committee, who has announced he's not running again. And that will be a much more competitive race now because of that. So expect kind of a barn burner with control of the Senate up for grabs and the House. So we'll be talking a little bit more about that. Reapportionment is a key factor in all this for the House, not for the Senate, because the reapportionment affects congressional districts. And of course, the senators run statewide. And what's important to know is that in 23 of the 50 states, Republicans control the governor and both houses of the legislatures, so they have effective control of the reapportionment. Only 15 states for Democrats. That will matter on a go-forward basis in terms of the political context, and by extension, what might be able to get done by way of taxes. And when I say that, Dean, that elections have consequences, my goodness, President Biden has come in and he's had a very, very bold agenda that he's announced. He has not signed that many bills. 11 bills have been signed in the first 100 days, and that compares to 48 by former President Trump and 76, I think, by LBJ. So that was the high watermark. So not many bills have been signed, but what has been signed have been, bold, important pieces of legislation. The American Rescue Plan, $1.9 trillion bill that was signed into law by President Biden, being the most significant, perhaps. And President Biden has relied, as recent presidents have done in modern history, more on executive orders. So again, looking at the numbers, 42 executive orders issued by President Biden, comparing to his predecessor, about 33 executive orders. The high watermark there would have been FDR during the initial months, weeks and months of the New Deal in the first 100 days. And many of President Biden's executive orders are unwinding some of the things that former President Trump had signed, including the XL pipeline, revoking certain drilling, the wall on the southern border. So a number of these executive orders are unwinding executive orders that were put in place by President Trump. So he is certainly making his mark. And of course, most recently, he's announced a $6 trillion annual budget. The president's budget is put forward on a fiscal year. And this is, again, a bold agenda. It takes into account spending and offsets, including revenue raises like taxes that were or are planned to be part of what's called the American Jobs Plan, which is what we think of as infrastructure and green energy, and the American Families Plan, which has got a host of different spending priorities, including free 2-year college and free pre-kindergarten for 3 and 4-year-olds, and making permanent the child tax credit. We'll get to that a little bit later, I think.
Right. I think, yeah, you covered it well there, Rick. And I think one thing I would say is that I think you touched on it is that, well, maybe not as number of bills, but I think you could be happy or sad about it. But I think in general, Washington was kind of taken, kind of blinked a little bit about the ability for them to pass with these margins, the $1.9 trillion COVID relief bill, and do it pretty quick, and get what they wanted and keep everybody together. Maybe not going to be as easy than for the next bills, and we'll talk about that. But that was impressive. I guess I'd say whether you were for it or against it, something about winning and getting it over the goal line.
Yeah, one thing again that we maybe will touch on a little bit more. I think some of the people who may be listening in have heard of the concept of reconciliation, which is a legislative process that, particularly in the Senate, allows has traditionally allowed for a vote once every fiscal year that bypasses the impediments of filibuster. And so you can pass it by a simple majority. There's lots of rules, which, Dean, you're very, very well aware of as an expert in this space, but it has been the process where lots of recent tax law changes have been made.
Right.
In this case, because of the fact that the timing of things, it's once every fiscal year, not once every calendar year. The Biden administration may have not just one bite of the apple, but because of a recent ruling by the parliamentarian on reconciliation, allowing effectively for it to be amended, we could see it being used more than once going forward. And so that would give the majority Democrats an opportunity potentially to use it once or twice or perhaps even more.
Right. We'll see. The parliamentarian I saw this morning, Rick, I meant to forward it to you, put out a clarification of what she had ruled on that. And it kind of dampened, I think, the Democrats' spirits about how much they could really, you're right, kind of take more bites at the apple. But we'll see. But so regardless, the administration's put forward these proposals. They've got a big spending level that they want to do on infrastructure, very broadly defined. And then they've got, well, okay, here's how we want to pay for it. And just to kind of take you all through this, and Rick and I'll touch on the major ones. And I should add, if you've got any questions, feel free to send us the questions and answers. We'll try to get to them as we're talking. But if not, we'll get to them at the end of the show, or we'll email you or contact you directly. So feel free to reach out to us. Happy to get those questions. But I know the big one, kind of the couple, 3 out of the box that got people very interested is, number one with a bullet, is capital gains rate, particularly with the administration's budget saying, well, yes, we're going to make that effective in a sense retroactively to April is what they're proposing, and then having the rate be at the OI rate 39.6 plus the 3.8% add on to it. Rick, what is your sense of the likelihood of that actually surviving the gauntlet?
I would say this will definitely get a lot of scrutiny. There are definitely Democrats, and remember, in the Senate they need every single Democrat to stick together. So every individual senator becomes a king in this sense, or a queen, and so they will need to be able to show some flexibility in order to get this package through if they have no Republican votes. And as expected, they will not probably have any Republican votes for any changes in the Tax Cuts and Jobs Act with the significance of capital gains or ordinary income or corporate rates. So my guess is, I think people were a little bit taken by surprise by seeing that April 1st date as the effective date on the capital gains rate, particularly because the proposal on the OI rate, the top rate anyway, is for it to be effective as of January 1st, 2022. And so you have a retroactive or a look back on the capital gains, which I think will give some Democrats, some key Democrats, heartburn. I would say, Dean, in my view, it is unlikely that you would see a retroactive hike on cap gains. I think you're more likely to see it run in tandem with OI and in terms of effective date. And the magnitude of the capital gains rate, by the way, it also affects qualified dividends. So it's dividends and cap gains for taxpayers with income over $1 million. Significant hike all the way up to ordinary income rates, including the passive investment income numbers. So you're at 43.4% for cap gains hike. I think that's extremely unlikely to happen. I think you could see a cap gains rate modestly increased. Let's say it's at 20 right now, to 25 or 28. Something like that is potentially in the cards, but I think extremely unlikely that you're going to see it all the way up to 39.6.
I think I agree with you completely on that. That is my sense of it. Is exactly that. Not retroactive. I think in line with all the other raisers. I think that'll have members wincing. It's extremely rare for us, other than abusive situations, to do a retroactive piece. And then the other odd thing is the scoring. And I know everyone gets their hearts beating fast about scoring of capital gains, but
you do.
It matters, yeah. And but the general feeling is that they will feel anything north of 28 will begin to lose revenue. The people will just hold back, and so that is a real problem. If you're actually losing money, you can imagine it's easy for the Republicans to just say, "Well, I've got an amendment to pay for children's ice cream. We're gonna lower capital gains and pick up all this money." And the nice benefit of delaying, say if you made it January 1st and you had the rate at say 28, just for discussion's sake, you actually would pick up a huge amount of revenue, just because, of course, everyone and his mother would be running to the sale table to sell or what have you. Just presuming, we kind of get this done in the fall. We'll talk about when this is all going to get passed, but that would be the feeling on that. Well, I don't want to.
On this one, Dean, look, I agree with you. It's extremely rare that you see a retroactive effective date. It's sort of less rare to see it proposed because, I think in all likelihood, what they're trying to do is calm people down. I'm pretty sure the people on the call are getting myriad questions about effective date. Should I sell my business? Should I do this to beat the change? And I think that, the purpose, whether or not they actually even intend to have it retroactive, the purpose, I think, is to maybe stop some of that in its tracks now.
Yeah, well,
I think it spooked the herd rather than calmed the herd. But
I think it has.
I like your theory on it. Well, good. Well, I don't, as you can see, I think it's something that, and we'll talk big picture when all these things are going to move here in a bit, but just to keep us on time and moving through, ordinary income, Rick, that I think is a little bit different kettle. I think that they probably will get up to the 30.6 plus the 3.8 add-on, but what's your take?
I think that's a mandatory for Democrats. I just don't think that they would rally to the cause. I think there'd be an insurrection, particularly among progressives, for any change other than going back to what it was pre-Tax Cuts and Jobs Act, which was 39.6. So I would put that in the hopper as near certainty.
I agree.
And
I do think, though, with the effective date, kind of to your point, Steve, I think with the administration making the effective date on that January 1st, 2022, I think they kind of set the table. That I think it's going to be hard for the Dems on the Hill to say, well, no, we want to, make it effective date of enactment, things like that. I think
Right.
they've kind of told us what it's going to be now. So I don't expect that to change. Corporate rate has been very interesting.
Just go back to that for 1 second.
Yeah, go ahead.
I think effective dates are really important, probably to our listeners in thinking about planning and what have you. In all likelihood, by the time there's two major provisions potentially, but a lot of the tax changes would happen in the American Jobs Plan, which is the infrastructure plan. I think by the time they get to actually making these changes and getting it on the president's desk and the president signing it, it will likely be September or October.
Right.
Already in June right now, there's a lot of work yet to be done. And so if it happens, as I think it will in the fall, then you're really only talking about the difference between late September, October, and December as the effective date for these new provisions, these changes. So I think it makes it a much easier leap. And if I was advising on planning, I'd say I think the most likely scenario is that you would see certainty around September, October in terms of what would be in these bills, and then effective dates on January 1st of 2022.
Right. And of course, you'll see
but certainly not retroactive.
Yeah.
Not
And you'll
retroactive.
certainly see effective dates very quickly in their drafts because, as Steve knows from working at Joint Tax, the first thing that Joint Tax, who does all the scoring, they ask the Finance Committee, where I was in the Ways and Means Committee, is what's your effective date? Because they can't score it without an effective date. So they're not going to hide or fog what the effective date is. They've got to tell you. So good point, Rick. And you kind of cover the big picture. I wanted them to understand that the train will probably, begin to start to get put together over the July period, but then it's going to be the fall. And you're right. Then the feeling is going to be, really, what are we doing here? The natural push will be, let's just do effective dates Jan 1 and get it out the door, because it will be a small time period where it is. Corporate rate. I thought it kind of, as the old joke was, Manchin kind of told us what it would be, Senator Manchin, when he said, well, I'm thinking 25 is the number. And going to your point about a 50-50 Senate, I think everyone said, well, I guess it's going to be 25. But interesting, just this morning, we saw the administration almost kind of willing to forego the corporate rate. And then they've had the dealings with Ireland and the EU and that issue. I mean, take us through how you're seeing that, Rick.
Yeah, so this has been a cornerstone in terms of finding offsets or financing some of the spending in the so-called infrastructure bill or the American Jobs Plan bill, and Republicans have been meeting with President Biden. He has signaled that he'd like to take a bipartisan approach. It was one of the areas where there was a sense that maybe the two sides could find some common ground, and in fact, Republicans have been meeting. They put a proposal on the table. President Biden's was a $2.3 trillion plan. Republicans came up with about $500 billion on the first offer. They have since increased that, almost doubled that to nearly $1 trillion. And there was a meeting last night with the president, the lead Senate negotiator. There'll be another meeting tomorrow. So that will be this Friday. With the Republican negotiators. They're closing the gap. And what President Biden, by the way, what Senator Capito says, who's the lead negotiator for the Republicans on the Senate side, said, it's easier. We find we make more progress working directly with President Biden than we do with his staff. Not that unusual. And so President Biden has put on the table, apparently yesterday, with Senator Capito, that maybe he would take the corporate the rate increase, the C rate increase out of that package. Doesn't mean it would go away completely, but out of the infrastructure package, and effectively replace it with his tax on book income. This would be for corporations with over $100 million of revenue. Would effectively be almost like an alternative minimum tax of 15%. And of course, it raises interesting questions around book versus taxable income, and who the audience is when you put together book, and is it the IRS or is it FASB that is going to write the rules in terms of what effectively becomes taxable? So a lot of interesting issues around that, but it was an interesting move on the part of President Biden to try and and bridge some of the differences. And so I think if early in the week there was some sense like maybe we're not that close together after all, and that may have provided a little bit of momentum.
It'll be interesting. You're right. The Republicans have gotten very unhappy. I just think in general, even if you're right, they do the corporate rate down the road. I think 25 is the most they're going to get on that, given where Senator Manchin's been, because no Republican's going to be for that. The book tax I found interesting just because I had heard a lot of Democrats were pretty fuss and feathered about that and weren't crazy about kind of the implementation. But we'll see how it all kind of unfolds.
And the one thing to watch on the book tax proposal is how NOLs get treated. That is a major cause for where there's a discrepancy between taxable and book income. So folks should be looking at that and begin to get themselves familiar with how this proposal might affect their clients.
Right. Steve, if you could maybe take us through the international side of the House, a lot of changes up there put forward by the administration, a lot of balls in there. If you can give folks an overview of how
Sure.
and then Rick, maybe you can fill in how you think it playing out.
Sure, and it's sort of, if you think about the concept across the Biden proposals, you sort of think time and time again, echo after echo, minimum tax. Let's make sure somebody's paying tax, and so much of what you'll see in the international area sort of parrots that. You'll see in the base erosion rules sort of a wholesale modification. When we first looked at the BEAT, we thought, okay, so if you're at 12 to 14%, you're not going to be taxed. That turned out to be roughly wrong because the rules were so different than that. What Biden is sort of doing is saying, let's put in a minimum tax, and the minimum tax is either going to be at the OECD minimum tax rate or no less than 21%. So, OECD is now playing around with a 15% rule minimum tax. I don't know whether they'll get that or not. Yellen is selling it this week to the group of 7. And we'll have to see. Some countries are on board, some of the EU is not. But the concept again is, out of these rules, and again, at 10,000 feet, because it gets remarkably complicated, you're looking at replacing the old threshold with a more direct tax threshold at 15% if it's the OECD, if they can come to some agreement. Have some doubts about that, but otherwise they'll put it at the 21%, the GILTI rate, which is the new rate of GILTI. Remember on the BEAT stuff, very large entities only, $500 million and above this applies to. So it's not applicable to probably a lot of our audience, but that's the first piece. The second piece is tinkering with the inversion rules. In the view of a lot of economists and a lot of tax folks, the anti-inversion rules that were done first by Reg and then otherwise haven't really done the job sufficiently. The Biden proposal is to sort of ramp up the noise, which is to, now there's a after the transaction, how many of the old shareholders remain shareholders. The rate was if you're 80% or above, you're in trouble. If you're 60 to 80%, you have some hair trimming to be done. The number's going to 50% and a lot of other changes as well. It is a toughening of the inversion rule. It almost makes it more into a more direct U.S. residency rule, and it should capture a lot more individuals. Whether it does or not, this is an area where people smarter than I are doing an awful lot of tax planning and seem to just turn the dial in order to miss the rule. But we'll see. GILTI, again, the GILTI tax was at 10.5. If you were above that, you were okay on foreign tax implications. It goes to 21%. It will go to less again if the OECD comes up with their number. But it's going to be an interesting world. Really don't know. Some other things in the GILTI area matter almost as much, which is, Biden would have this done on a country by country basis instead of in a blended rate. And that will create a large difference and a bit of complication as well, of course. There's also an elimination of some of the other stuff that was done to ameliorate the tax. But at the end of the day, it's really the increase of what you have to hit in order for GILTI not to apply. And it does apply across an awful lot of folks. It's unlike BEAT, it does hit people. The last piece is FDII, the foreign derived intangible income provision, which was always a misnomer, by the way. But FDII was giving a benefit to people. That benefit's being taken away. It's gone. It will be gone. It will be replaced in some basis, and I think, Dean, you could speak to this better than I. It will be spent in R&D.
Right. That's just quickly on that. And I want to turn to Rick to give us kind of the feeling is FDII is probably of all of them kind of on the way out the door, that's already been tagged as the revenue raiser to deal with the the amortization issue for R&D. Plus the administration has kind of vaguely said do other expansions of the R&D credit. I think the best candidates are expanding the startup credit that Senator Coons has been championing, but also maybe looking at an enhanced credit for domestic manufacturers. We'll see what they end up with, but that's very much eyed as the pay for to deal with the amortization issue. But Rick, any other big picture thoughts you've got on the international you want to share before we move on to the rest of the run on this?
No, this obviously has less of a populist political dimension to it, so it becomes a little bit more I don't want to say insider baseball, but there are certainly technical implications, and philosophically, I would say that where the Biden administration is coming from relative to where the Trump administration was coming from in dealing with inversions is that the Trump administration wanted to create sort of carrots for people to come back to the U.S. and invest in the U.S. and not offshore intellectual property, intangibles, what have you. Whereas the Biden administration is taking much more of a punitive outlook that if you go that route, you're going to pay higher taxes. There are going to be consequences. There are going to be penalties. And so there's I think a philosophical shift in terms of how you deal with the inversion issue and the competitiveness issue on the international side. Ireland, by the way, has been squawking quite a bit about anything that would harmonize.
Ireland, Hungary, traditional places that have succeeded in being low tax corporate jurisdictions are not surprising that they're squawking about the minimum tax. And I would say, Rick, you're right. I think the people will point to different things, right? People will point to the fact that many of these provisions didn't bring in the money that they were supposed to. On the other hand, it's only a couple of years. So who the heck really knows whether they were going to work or not?
Right. I want to keep us on time here and be mindful of our listeners. A few things just to touch on that I know are near and dear. 199A, to me, Rick, that's the dog that didn't bark. It wasn't in the administration's proposal. I think that was big news. It was never really something they rang the bell on during the campaign. You really had to kind of go to the footnote of the footnote to decipher that maybe they were looking at 199A. But the fact that it's now not appearing, I know a couple members have gotten grumpy and are grinding, but I would think in general 199A is pretty safe for the time being. Any thoughts on that from you, Rick?
No, I agree. 199A was in the Biden campaign playbook. This was, the provision, obviously, all listeners know that affects smaller businesses, pass-through entities, and it was not in any of the proposals that have been advanced by the Biden administration since he's been in office, and so it seems to me it's politically much more difficult for Democrats. My guess is the Biden administration maybe had a couple of conversations with a couple of the key Senate Democrats who said, like, I don't know why you'd go near that and raise taxes on small businesses. So I'd say that if I was a betting man, I'd say that's probably out, but I wouldn't completely shut the door to it. Depends on where they end up and what kind of gap they've got to close.
Out in terms of not going to be touched, right? Yeah.
Stepped up basis and just basically a state tax. I'll take them together.
Go ahead.
Sort of politically dicey area, especially for some of the rural Democrats that have big farms or ranches in their states. And again, I'm focusing primarily on the Senate side now. The proposal is to eliminate the stepped-up basis for larger states of over $1 million, not really that large, and to reduce the exclusion, which is now I think 11,700,000 down to 3.5 million, which would be a very dramatic decrease, lower than it was pre-Tax Cuts and Jobs Act. I think there's going to be a lot of pushback around that number as well, and the president would also increase the rates on the estate, so from a high of about 40% on the marginal rate to about 45 or 46%. So pretty significant increases. My guess is that you will see something. If anything happens in here, I think stepped up basis is going to be out. I don't think it'll even be in. It may end up at a higher number, perhaps. Maybe it would be at a number above the pre-TCJA levels of exclusion. That may be where they end up. So I think there could be something there, but if I was a betting man, I'd say that is going to go completely. I think rates could well go up for larger estates. I think that will happen. And don't forget, with all of these things on the individual side and on the estate side, Dean, that if nothing happens in 2025 and in 2025, it all reverts back to pre-TCJA. So
I think that's
as long as Democrats have either the White House or one of the two chambers of Congress, either the House or the Senate, they don't have to do anything. Right. Those rates will go up and those exclusion amounts will go down. So
right.
That.
I think you said that well, Rick. I mean, I think if I'm sitting there and, you've actually been in the catbird seat, but advising the folks in the catbird seat, I think you're just saying, tell me again why I'm going to spill all this blood and grind and be in misery for something that's going away in 2 years anyways. Why do I need to do this?
I spend the political capital.
Right. And then, someone can come forward, even though maybe not be as rich or robust of a benefit now, they could say, well, I'm getting you into a better place than you were, kind of a deal. So, right. I think the rates is the thing I think they could do, because they'll say, yeah, for the biggest states, we're going to get the rates up and say, by God, we showed them. And then the others, I think I think it's a real raccoon sack.
Just one point, if for some reason Democrats picked up 2 or 3 seats, by the way, in 2022, and didn't need a Senator Manchin, for example, or a Tester, or Kelly from Arizona, didn't need those swing votes. They could revisit this and it might be much more aggressive. But
right, we'll see. It's one of those things very well, Rick. It's not like maybe OI or something like this. You suddenly get a lot of folks kind of popping up that have concerns about this, and we'll see, right. And then see what the House is.
And just quickly on child, we already covered international, so child credit and EIC. It's really kind of institutionalizing some of the temporary provisions.
Right, that's right.
Child tax credit, which is $3,000 per child for children under 17 and $3,600 for children under 7 years old. So this is really making it permanent.
So that's a big push for them on that, right, for the administration. That's right. Let's go ahead then now, and I'm sorry here. There we go. Rick, just real quickly, because I do want to kind of running a little bit behind. I think you've given the sense of the timing and the big picture, but is there anything else you want to make sure we cover and understand for our listeners of how you see the next kind of few months unfold?
I think we basically covered this, Dean. I would only say that I think we're very near to the point. I would say within the next 2 weeks, we will know whether there will be a bipartisan deal or whether the Democrats will go it alone. If the Democrats go alone, expect that the plan will be more aggressive in terms of both spending and offsets on the tax side.
I think that's exactly. One quick thing I wanted to know for listeners is the Senate Finance Committee marked up the energy bill, and that's kind of now on a side rail. It won't go as a separate bill. It'll be a bolt-on to the infrastructure bill. And I just noted that there's a number of energy provisions, wind, solar, you name it. So if you're interested, call me or contact me and I can walk you through it. But 2, I really wanted to highlight, because we do so much work with you on 179D. Well, they just really expanded 179D. It's now goes from $1.80 to $2.50 up to $5 per square foot. They are going to allow nonprofits, charities, Indian tribes, all to benefit. And again, then having the allocation to the designers involved. That's big news. It's just, left and right, there's a host of things that they've done to expand 179D. It's something the administration is very keen on as part of their effort to improve energy efficiency. 45L is something that is going for construction folks of homes, including modular homes, things like that, that they're going to get a $25,000 to $5,000 credit as well too if they're energy efficient. That's kind of a thumbnail on it, but I just wanted to highlight that for you. These things will probably have a strong chance of being included in the bill and getting signed into law. As we all know, the administration is very keen on a lot of the climate and energy issues. So I just wanted you to be aware that that's now passed the Finance Committee and is waiting to be brought into whatever bill is moving in the infrastructure area. Rick, just finish up to us on the employee retention credit. This was part of the COVID relief bill. I know you've been living and breathing this, probably working with a lot of our clients on the phone here on this, but give us just quickly your thoughts on how you see that as we move over to Steve and Eric.
Yeah, I want to be time efficient about this, Dean. So I'm going to try and summarize the main point. The employee retention credit was part of the original CARES Act enacted in March of last year of 2020. It was a fairly modest credit. It was limited to businesses primarily of under 100 employees. If you took a PPP loan, you were precluded from getting the employee retention credit. So there were really a number of impediments. The credit itself was less generous than it could have been. Fast forward to December, and the bill that President Trump ended up signing in December expanded the employee retention credit, eliminated the prohibition against taking PPP loans and seeking an employee retention credit. This is a credit per employee for the first $10,000 of compensation. In 2020, it was for the year. In the new version, it was 70% of the first $10,000 of compensation per quarter. So a significant expansion in the amount and the desirability, and businesses up to 500 could apply. It has fast forward again, and in the most recent stimulus proposal, it was expanded so that it applies to all 4 quarters. What's important here is that there's a couple ways to qualify. A lot of people are focused on the requirement, the one pathway, which requires you to demonstrate a 20% decrease in revenue over the corresponding quarter in 2019. That is only one way to qualify. And in fact, we are finding that the vast majority of businesses that we're helping are not qualifying that way. They're qualifying because they faced a complete or partial, important term, partial shutdown as a result of government directive. And there's a whole list of different activities. Right. It could be that your sales force couldn't travel. It could be supply chain was broken because of a government order. There could be any number of reasons. So please get to us, and we're happy to kind of give you a download on this. Yeah,
it's much broader, and it's that second path, and we're just helping a huge number of folks find out that they can qualify for it. But the other part is we kind of allude to is doing it right and documenting it correctly so that when the folks come knocking that you're ready to go. I'm going to now transfer it over to Steve and to Eric. The big asterisk in the president's budget we didn't get into, Rick, because we want to leave it for them, is the $700 billion that's going to magically come from IRS enforcement, and a big increase in IRS spending and what have you, is very much, I think, on the books, and Congress is looking at doing that. And Steve and Eric, let me turn it over to you in terms
why don't we go to the next slide, Dean? And
first, talk about Eric again, huh?
I want to talk about Eric again, but I want to do 2 things. One, Rick and Dean said, "Oh, we're only going to do 30 minutes. Don't worry about it." They lied. They always do.
We didn't count on 10 minutes on international.
They always do. But that's okay. So 2 things. One, we'll do what we can today. You should know that in 2 weeks, Eric and I are going to be doing the entire presentation on enforcement. So if you have an interest, please tune into that one. We'll have the ability not to listen to Rick and Dean for 45 minutes. But going back, I'm really happy to have Eric with us. He adds a remarkable amount more breadth to our team. He is much more current, as you'll see in our discussion, with what the heck the IRS is up to. I'm going to set the table here in the way that Rick did for the enforcement side. There's been a lot of discussion about the tax gap. What the heck is the tax gap? It's the difference between what should be paid and what gets paid. What are the numbers? Who knows? But the last time the IRS put out official numbers, 440 billion plus in monies that were missing. After enforcement, that went down considerably to 380 billion. Lo and behold, in the middle of April, Chuck Reddick, the current commissioner, says, hey, it could be as high as $1 trillion, which is a big difference, right? Why is it $1 trillion? When asked, he sort of pointed to crypto, pointed to a few other things. Don't know what the real number is. There's also a report out there, and this sort of underlies a lot of what you see in the Biden proposals. There's a report out there by some IRS economists that were sort of working with the NEBR, but they were working on and have come out with something that, in their estimation, the top 1% of taxpayers don't declare about 20% of their income. And that's a huge number. And they pointed at sophisticated evasion. They pointed at offshore. Is that number right? I doubt it, but we just don't know. But the bottom line is, what we do know is this: the IRS is in a bad way. Audit rates are down more than 60% from 2010 to 2018. Audit rates of millionaires are down to below 2%. When I was there, we were anywhere between 7 and 11, depending on where you did the line. So it's a remarkable decline in this. TIGTA put out a report saying, non-filing by high income folks is up 50% over the last batch of years. By the way, the year we looked at, there were 900,000 wealthy people who did not file. 400,000 of those were never touched. Why? Eric will yell at me, but what TIGTA said was resources. But that's what we're living with right now. That's what we had. So what we have, if you think about this, what we have with the Biden proposal is a recognition of this. They gave it credence and they pumped up the volume. They pumped up the volume in the 2022 budget by 10%, up to 13 billion plus 13.2 or something like that. It had gone down to around 10. So that's a significant increase. It had increased actually over the Trump years, where they thought they were in charge and therefore they thought they should be funding this, but it's not been enough. The bigger thing is, in a new sort of attempt, there's an attempt to sort of make sure that there's an increase in the IRS budget over the next decade. More than $7 billion a year, up to $80 billion. And Dean's going to whine about this in a moment. They scored it. The administration scored it. They ascribed it money. We have no idea. I have some sense what the Joint Committee, my old employer, will do. Dean will speak about that, I'm sure. But they scored it at, overall for the staffing itself, 300 plus billion, overall 700 billion. It's a lot of money over the 10-year period. It was paying for itself. And we traditionally have believed, when I was at the service, we believed we could argue, $4 to every dollar that you spent on enforcement. It actually was closer to 10 to 12 in some areas. All that's to say, what we have in this area is a larger budget, but there's some other stuff as well. So go back one. I know you're moving me along, Dean. Would that you had done that earlier, but that's the wrong way. That's there. We can stay right there. I'd like actually Eric to talk just a little bit about the 4 bullets here. In particular, the additional reporting that's being suggested is a remarkable game changer, and it may not have any possibility of passage. Some of it may. So Eric, if you could touch on some of those points, that would be great.
No, I appreciate that, Steve. No, I think overall, as we look at, this increased budget, I mean, everybody within I think the tax ecosystem is a little excited about the increased funding, proposed increased funding for the service, because as we think about over the last 10 years, the service has lost almost 20% in funding, which has had a significant impact. You kind of hit on some of the statistics that, that as far as audits and different things of that nature.
So 17,000 fewer enforcement personnel, 6,500 fewer revenue agents than 2010.
Yeah, and that's going to have an impact. So it's really something that I think this infusion will be a benefit. Now, as we look at, we have here increased audit rate. Now, the service has, changed the thought process as to whether just the concentration on audit rate is more so looking at it from a compliance presence, and it's looking at the fact that, all right, you're going to have field examinations, you're going to have correspondence examinations, then you're going to have automatic unreporters. That's which an individual gets a 1099 and they do not report it, but the service receives that 1099. So you're going to have that presence. Then you also have the automatic substitute for return, which is for your non-filers, as well as math errors. So they're looking at it from a broader standpoint versus just the increase of the audit rate. Is the compliance presence, because most taxpayers will think about it if they're actually touched by the IRS, whether through a correspondence or an audit, they feel like they're being audited to some degree. So with that being said, there is, I left about 2 months ago, and there was still a strong emphasis there to increase the number of audits on high income taxpayers, individuals or businesses that had total positive income of over 10 million. And then there's some thought as to individuals over 1 million as well. So that is going to be a strong focus as we think about going forward for high net worth individuals. As far as technology, now the service and with this infusion, that's going to be a key focus for the organization as we think about just innovative machine learning. When I was there, we really approached a lot of machine learning, artificial intelligence, whether it's from a criminal investigation standpoint, whether it's from a civil standpoint, and really kind of marrying up. And this is a new strategy for the service, and marrying up subject matter experts as well as with data scientists, as well as behavioral scientists, to really address the issues of non-compliance. So that's going to be a key focus for the organization, so that they can really address those emerging issues they're coming about. And from a behavioral science standpoint, you have in trying to improve customer service, we have that here as well. They've just appointed Ken Corbin, the former commissioner or the commissioner for wage and investment, as the new taxpayer experience officer, to really kind of think about ways to improve that. One of the ways is the fact that you'll see some of the CPAs the clients may receive, there's a QR code that's going to be on various notices, in which individuals will have to, and they can just use their smartphone and just wand over that QR code, and it'll take them directly to how to actually pay or set up an installment agreement. Now, the elephant in the room obviously is additional reporting. And, Steve, you touched on the tax gap, and as an enforcement guy and spent 30 years as an enforcement guy, you always think about additional reporting is great. And so as we think about—
You were thinking about handcuffs, though.
Yes, I did put handcuffs on a few people. But it's something that I think the service has consistently been pushing. And I think as we look at many of the IRS data books that are produced each year and the tax gap report, you'll see that additional reporting helps with overall compliance and reducing the tax gap. So that's going to be a significant area. And as we can see here, up for debate, creating this new financial reporting regime, which I think is going to be interesting, because you're thinking of financial institutions reporting the inflows and outflows with a breakdown of physical cash, transactions with foreign accounts, and transfers to and from between the same individual. And so that's going to be interesting. And I'm not sure whether we'll get some pushback in regards to implementing that. Reporting on cryptocurrency. That's going to be huge in regards to individuals, very similar to if you deal with a business or deal with business in any transactions over 10,000. So that's going to be reportable. And that's going to be a significant game changer for everyone.
And I think while we're talking crypto, there's another provision that sits back there about beneficial ownership. So I think exchanges are going to have to know who they're dealing with and have the necessary information.
Yeah, I think that's a great point. I mean, just in my 20-something years, the opaque nature of beneficial ownership and some of the issues that are associated with that has been a significant issue. And so to add that to these provisions, I think it was going to be a great benefit to the service as far as from an enforcement standpoint. So that additional provision is going to be really helpful. So actually coming up with an article in a couple weeks on, or it should be next week, I should say, with my former colleague, Don Ford, former chief of CI, and we're going to kind of talk about some of these different new provisions as well. So touching on, Steve, I know you want to touch on captive as well.
Yeah, no, so let's,
Eric, what's the IRS waking up thinking about?
Yeah, that's the issue on this slide. We basically are looking at, we see what's in the budget, but what is the IRS actually focusing on today and intending to focus on in the next period?
The first thing the IRS is going to be focused on is high income net worth individuals. International is going to be a hot issue for everyone as well, because as we've seen just recently, the last couple of weeks, there's been a prosecution of another Swiss financial institution, an insurance company. And so therefore, there's going to be a significant amount of clients that they're going to have to disclose to come forward. There was another financial institution that was just prosecuted. So that's going to be a significant increase. Obviously, over the last couple years, captive insurance, micro-captive insurance, conservation easements are still going to be a focus as they've seen some wins as it relates to micro-captive conservation easements. There's been a few prosecutions that's moved forward as far as conservation easements and in regards to more so valuation. So that's going to be a significant issue. I think there's going to be some issue it relates to employee retention credits. We're going to probably see some activity there because as the service is aware, anytime you institute a credit, you're going to have some nefarious characters that are out there that's going to try to take advantage of these credits. You know, that's the importance of having an organization like Alliant Group to really kind of take you through, the qualified wages, the gross receipts tests and different things of that nature. So that is another area in which the service.
You're going to highlight what Dean said before, because you should be taking this. The ERC is a wonderful refundable credit. It is given by Congress for exactly the people that need it. What needs to happen is there are some complications, as Rick has said, about less about gross receipts, more about what does a partial shutdown look like. What do you have to show? All of this requires, documentation.
Yeah, you got to document.
Put together something. You put together that information that you relied on to get that number, and then you put it on your dang shelf. The IRS may or may not ever show up, but if they do, you don't have to resurrect in your mind what the heck was going through your skull at that time and how the numbers work. You have something, substantiation that will guide the IRS through, and you can get back once you put that on the shelf. You can get back to your business, which is more important.
Steve, Eric mentioned the captives and conservation easements. I think for most of our listeners, they know we do obviously represent folks in front of the IRS, and that's something that we're so thrilled to have Eric helping us with in terms of how to best put the foot with
so
the
IRS. I lead a large tax controversy office. We do tax planning, and we especially do audit defense. We have a batch of stuff in actually all of these areas, not yet ERC, but in the other areas we do. I also mentioned one thing on conservation easements, hidden in the bill somewhere, and not in the bill, but in Biden's budget is sort of an interesting tweak to the listed transactions rule, which conservation easements is one. And that is twofold. One, you have to file your 8886s electronically, which will make it easy for the IRS to look at. And secondly, and a little more concerning, the 3-year statute of limitations that's normal pops to 6 years. And there's been very little discussion of that, but there is a batch of stuff in the budget bill that will get discussion, but hasn't yet. But with that, I think, Dean, we'll turn it back over to you and to Rick, actually.
Right. And I just want to leave with that one thought, though, is like I said, having Eric helping us on a host of fronts, but in your work representing in terms of audit defense, it's just incredibly helpful to have Eric helping advise and guide us. I know obviously you got a wealth of experience and we have others, but it's terrific to have him on there. And so, please obviously feel free to reach out if you're seeing those issues. Cybersecurity, another area we just wanted to highlight, just because every day, Rick, it's in the news. Good Lord, I can't get the ferry to Harper. I can't get to the Martha's Vineyard. I can't get a steak. I can't, good Lord, it's what's going on?
Right,
no steak and no Martha's Vineyard.
No Martha, and I have to gas up my car now every time it's below 3 quarters. I'm like, okay, I gotta get my gas back in as I run to go get toilet paper at the store.
Yeah, Dean, obviously cybersecurity is a major concern of the IRS, and Eric and Steve can tell you about that. But we have seen a spike in cyber attacks on the private sector. We've seen hospitals attacked, we've seen schools attacked, ransomware demanded, and in some cases paid. But 2 high-profile cases that most of the viewers are aware of, that's JBS, the big beef distributor, manufacturing distributor that was attacked, and then prior to that, Colonial Pipeline that was attacked. And you're going to see more and more of this. My ask, I guess, of the people on this line is to make sure both that they are protected. You never think it's going to be you, but believe me, there are 2 types of businesses that I have found: those that have been breached and are dealing with it and know about it, and those that have been breached and don't yet know about it. But the bad guys are in your system and they're building information and they're looking for a sophisticated way to attack you and shut you down and hold you up for ransom. So if you don't have an incident response plan, if you don't do regular penetration testing, if you don't have access to what we call a virtual chief information security officer or a resource with technical background, remember, functionality and data security are 2 different things. You want to have different professionals focused on that. We've been through our own journey at Alliant Group. We've built a absolutely best-in-class cybersecurity operation, and now we're helping other people do the same thing to protect themselves and their clients. So I just want to mention that please don't be complacent. Don't think you're too small or that you're off the radar screen. Nobody is anymore. The attacks are real and they're crippling.
I didn't mean to, that's what just shocked me about the gas one is they said, well, it just didn't occur to us because, we don't interface with the public. We're not on the internet. It was all internal, and you're far smarter than I am, but I just didn't know that was possible. And they just said, oh yes, they got pierced, and you don't have to be, having your website or, things like that I think a normal human would think, hey, this is just me internal, and they still got out there. So
absolutely. And we led this particular area in our firm is led by former Secretary of Homeland Security and former Pennsylvania Governor Tom Ridge, who has a great background in cyber defense and a group of incredibly talented technical people. So again, we'd love to help you if you need the help.
Yeah.
Can I add a point there on that, Dean?
Go ahead, Eric. Absolutely.
Within the proposal, there's an increase for the IRS for cybersecurity because the IRS gets 1.4 billion attacks a year as it relates to cyber. I mean, which is pretty amazing that we hadn't seen more hacks of the IRS system. But so that's another piece that's going to be in this proposal as well.
Well said. And for the accountants listening, they need to. If they're interested in the IRS, they could very well be interested in the accounting firms as well too.
Yes.
So I apologize, we're kind of out of time. There was one question I did want to get to that was very patient. I think I can answer briefly. They had raised on the basis increase, that step up in basis, that how would people even know what their basis is if it's, grandpa's farm, you got to figure it all out. I think that's a fair point. I think that adds to why Congress is going to be pretty itchy about what they're doing in the step up basis, but it is an argument that we hear and it'll be out there. But I apologize, we can't get to all the questions. Feel free to reach out to us. You got everybody's emails there. So feel free to contact us on any of these issues, and with any questions you've got, we're happy to help and greatly appreciate it. I'll let my panelists say any last words they want, I guess, starting with you, Steve, Eric, and then let the congressman finish us up.
No. Thanks so much for taking the time.
Thank you, everybody. Look forward to working with you.
And I will just say, our group of professionals is here at your disposal. We want to be helpful, and I think we've got a pretty much unrivaled access to people that can give you intelligence and can help you advise your clients and build a strategy that will make you look great every week.
Thanks so much. Have a wonderful afternoon. Cheers.
Thanks, guys.